All right. Well, good morning. Let's get started. Who'd like to give an opening prayer? Anyone feeling inspired? Maybe somebody besides Baker. Baker seems to be giving a lot of opening prayers for us.
Yeah, I'll do it. I'll do it.
All right. Thank you. Appreciate it.
Our dear kind Heavenly Father, we're very thankful for this day. We're thankful for the chance we have here to learn more about numbers and how the world works. Please bless us to be safe today and to enjoy all of our endeavors. We love thee very much and ask for these things in the name of Jesus Christ. Amen.
Amen. Thank you. Very much appreciate that. Okay. Mariah, do you have our devotional this morning?
I do. Okay.
You need the screen?
Yes, I have a video.
All right. Go for it.
And if it starts like skipping out, my internet's really bad right now, so I apologize in advance.
No problem.
Come on to Jesus, ye heavy laden, careworn and fainting, by sin oppressed, he'll safely guide you unto that haven where all who trust in him may rest. Come on to Jesus, he'll ever heed you, though in the darkness you've gone astray. His love will find you and gently lead you from darkest night into day. Come on to Jesus, plead for his love, and know that angels are near you up above. Come on to Jesus from every nation, from every land and isle of the sea, unto the high and lowly in station, ever he calls. Come on to me. Come on to Jesus, plead for his love, and know that angels are near you up above. Come on to Jesus, ye heavy laden, careworn and fainting, by sin oppressed, he'll safely guide you unto that haven where all who trust him, where all who trust him, where all who trust in him may rest.
All right. right. So that's a song I heard a while back at like it was a Valentine's young women's activity. And when I heard it that time, I loved it so much. And until recently, I could never remember what it was called. And so when I finally found it again, I just realized how much I loved it. Like, I still love it. And I just love the message that it shares that um, even like if we're, obviously mean to someone or we have sinned, it doesn't matter because in the end, we're all forgiven of as long as we go unto Jesus. And so I say these things in the name of Jesus Christ. Amen.
Amen. Thank you, Mariah. I appreciate that. Does anybody have any thoughts they want to share? Any impressions that they felt from watching the video? Any feelings? I'd never seen it myself, so I don't know if any of you have already seen it or had impressions when they saw it for the first time. I think one of the obvious lessons of it, right, is I think Elder Maxwell used to call our interactions with one another or our each other we're like each other's clinical material when it comes to showing how we live the gospel, right? And so that to me shows perfect example of how, or at least a great example, not necessarily a perfect example, but a great example of how important it is to really treat one another with kindness, because you never know what somebody's going through, what somebody will go through, what kind of impact they might have on your life down the road. But even then, it's just, frankly, I think we find a lot more joy and peace when we treat each other well, right? Versus, trying to always get justice, right? If we're always trying to find justice in our injustices, I think we end up being terribly unsatisfied, even when we achieve that justice. So that's one of the thoughts I had from it. Well, thank you, Mariah. Really appreciate that. Next week on Tuesday, let's see, we've got, Raphael. I think you had already shared back on the first day. You're up again, so appreciate you signing up again. Raphael, you're next Tuesday, and then Cooper, you're a week from today. Okay. All right.
Can I comment on the video?
Absolutely. Yeah, go for it.
I never saw the video myself before. I really like how even though sometimes people hurt us, we as a members, I will say, we have to help others. There is no other way for us. When I was getting the lessons from the missionaries, they were like, they were telling me, when you get baptized and you get a member of the church and you become a member, there is no more agency for you. You have to always do the right thing, and every time will be smaller your chances to fail. So I like to think that someday someone is gonna hurt me, and I need to be there for that person, or for whoever, for my family, or for friends. And I love the video when she was jailed by that guy, and she was the one to take him out. She was the one to take him out of the truck. That was cool.
Yeah, I like that thought that we kind of give up our agency. And it's not so much that it's taken away from us, but much like how the Savior submitted his will to the Father, that's what we're doing, right? When we are baptized, and every level of covenant making that we do in the gospel is really just us submitting our will to him that much more. So thank you, Raphael. I really appreciate that. Anyone else? Okay. All right. just a tiny bit of housekeeping before we get into discussion. So obviously we will not have class on Thanksgiving, the 26th. So I think that's pretty clear. Now, what I'm going to do, since we don't have class on the 26th, is kind of shift our calendar a little bit. Not next week, but the week of the 9th, which is kind of our Monopoly exercise week. So what we'll do is on the 10th, class on the 10th, we'll talk through the Monopoly assignment. Make sure you guys are kind of clear on what that's required. And then we will actually start getting into the material managerial accounting on the 12th. So we'll start discussing that on the 12th. Your first homework assignment won't be due until the 18th when it comes to that material. But because we lose a day, I want to try and get ahead of it so that we, after Thanksgiving break, we're kind of back on schedule. Okay, so that's what we're going to do. We're going to kind of shift things a little bit and bring up a day of discussion. You won't have, since you don't have an assignment due on the 26th, we won't have to shift anything there, but you do have an assignment due on the 27th. And what I think I'll do is I'll just shift, since that's the day after Thanksgiving, I'll shift that due date to the 30th. Okay, so I'll give you the rest of the weekend. Won't be due the day after Thanksgiving, but it will have to be due. It will have to be due after the Thanksgiving weekend. So you'll have all day Monday to get it done. Okay. All right. You're welcome. All right, so discussion. I think we've got, hopefully, is it group 4? Hopefully you guys have something prepared today.
Yeet.
We forgot.
Okay, who, you guys have something or not? Or are you serious you forgot?
No, yeah, we do.
Okay.
Oh, dude, you should have said anything.
All right,
Who
well,
has
who
the
wants to
Google
kick it off?
Slides?
Sorry, what was that?
Who has the Google Slides?
Oh, I don't have it. Eden?
I'm lagging up a storm because my internet's bad, but I can try. Let me see. Can y'all hear me?
Have it, Brigham?
Yeah, we can hear you.
I have it. Okay, good. For some reason, my internet decided not to work this morning. Okay, can you see it?
All right, perfect. Yep.
Good.
Hey, Cooper, you're muted.
Oh, was Cooper talking this whole time?
Oh, that would have been fantastic to know. My bad. Good morning, class. Good morning. Good morning. We're going to look at the types of ownership here for our presentation. So let's begin. There's a few forms of business, and they are in this order: sole proprietor, partnership, corporation, and or an LLC, limited liability. So we're going to go into the definitions there and see what each of them are.
So thanks. For proprietorship, we kind of see in the picture, right? We can imagine that this Mexican guy sell tomatoes out of that truck, and he's a business guy. He has the liability, revenue, and the losses are he and losses are his losses, right? So sole proprietorship are owned by a single individual who is responsible for making business as a profit distribution decisions, right? If you want to be absolutely master of your destiny, you should organize your business as a proprietorship. So we kind of see this guy alone selling his own tomatoes. We can imagine what he's doing, right? Trying to get the best prices for his tomatoes. And another thing, partnership. For example, these two guys, Bob and I, sell tomatoes out of a truck, and this is type of truck in Moragas, Saudi Arabia. We are the business, and we have shared liability and split the profits and losses of the business. So they both take the risk, right? Partnerships allow persons to share their talents, capital, and the risk and rewards of business ownership. Because two or more individuals share ownership, partnerships require clear agreements about how authority, risks, and profits will be shared.
Okay, corporation. A corporation is a separate legal entity created by the authority of the state government. The paperwork to start a corporation is complex. For most labor persons, engaging professional attorneys and accountants will assist with the paperwork. Is well worth fees and the charges. Let's see. So we have another example here. For some reason, all of our examples were tomatoes, thanks to Cooper. So Mary Sue and Bob and I filed paperwork to create a tomato trunk incorporation and hire several people to sell tomatoes for us. In exchange for our investments, we received 10% of the available stock in the company. Our shares are preferred stock, and the Truck Tomatoes Inc. retains the remaining of 60% of available stock. We are not a business. We do not receive any profits or losses from the business. If TTI chooses to sell more stock, it will sell as commons.
Okay, and this one is the limited liability corporation of the LLC. The definition we have, the company is a U.S. specific form of a private limited company. It is a business structure that can combine the pass-through taxation of a partnership or sole proprietorship with the limited liability of a corporation, which is good. It helps for growth, but also protects the owner a little bit. And so, a little example, it says, I file paperwork to create Truck Tomatoes Incorporated and hire Bob to sell tomatoes for me. I'm not the company, but I do own the company. I have some protection from liability, and the company profits and company's profits and losses transfer to me.
Sweet. And so I prepared a Kahoot now. Let me see if I can get it up there. Yeah, it's right here. So if you just want to put, here's the game pin right here. And if you just make sure you put your first and then maybe your last initial here. So the Kerbal can see who participated and who didn't.
Mm-hmm.
That'd be great.
Where's our music?
Where's that music?
Yeah, come on, man.
How do I get music out here?
Hear your audio through the computer. So
Oh,
like go
shoot.
down,
I have it on. I just don't know how to get everyone else to do it.
go down to your like little microphone button and then hit like the little arrow and it should show you different options. Or go up to the top and find where it says it as well.
I have no idea. I don't think I'll be able to do it.
If you just reshare your screen down on the bottom left corner, it should say share your computer sound. That's the easiest way to do it.
There we go.
So
Yeah, I was like,
reshare
I
your
knew it was there. Yeah.
Cooper, throw the beat.
There we
By
go.
sharing. All right. I'll just wait like one more minute. Okay, now I'll get it started.
Okay, this is how I base your participation grade, guys.
Oh.
The first one is just a poll, just so everyone knows how it works. It doesn't count for your grade or anything like
Man, I
that.
missed it. Sorry, I went to the
Unbelievable.
restroom. What was the code for the Kahoot again?
It's right here.
All right, so
1409412. Sweet. So people think pineapple does belong on pizza. They might be wrong. So yeah, sole survivor. I have no idea what that can mean, but it's not a form of business. If it is, it's not very good. We have Sarah Man and Leave. I think that's Raphael. He's just fallen a little bit behind, but he's got it. What is the disadvantage to a sole proprietorship? So yeah, it's this one. Owner is 100% liable for business debt. That's a big problem. I actually mentioned that they are not targeted by OSHA, which is actually a real thing. If you're a sole proprietorship, you don't have to, you're not reliable to OSHA. And it's actually a pretty smart thing. I worked for
Really?
a sole proprietorship. Yeah, I worked for a guy who constructed homes, and
Raphael.
we did plenty of things that OSHA would probably kill us for. I know that OSHA thing is correct in construction. I don't know about other forms.
My screen is stuck on which is not a form of business, so don't judge my answers because I literally can't see anything. So
Oh, sorry.
all the weird answers, that's me.
Yeah.
Who do we have now? Sarah's back in the lead. I don't know who teach. Oh, is
That would be me.
teacher? Okay.
Yeah.
All right, true, false. An LLC provides owners with limited liability while providing some of the income advantages of a partnership. That's pretty true. It does a combined thing. There's also a thing called an S corp that is pretty similar,
Mhm.
but not.
Yep.
So yeah, corporate owners are not liable for the debts of the company. When you make a corporation, it's considered its own person. We got Spencer in
Spencer.
third. We got teacher in second. Sarah at first.
Way to go,
Oh,
Sarah,
run it up,
all
baby,
over
run
it.
it up. Let's go.
All right, I'll stop sharing.
All right, well done, guys. Appreciate that. Hey, my phone says second place, the stuff legends are made from. That's good to know. It's very inspiring. Kahoot legend. All right. Yeah, we're getting in this habit of Kahoots. Always fun. Kind of wakes us up in the morning. I appreciate that, guys, and great presentation. One wanted to point out, I didn't want to get too technical. Your example on the corporation of the 4 owners owning 10% of the preferred stock, and then the corporation itself owning the other 60%. First of all, I didn't know where you got where the 100% of common stock, where the rest of it went, right? Because and secondly, I don't know how a company owns its own stock. So anyway, I didn't want anybody to get confused on your illustration, as much as I appreciated your attempt to provide a. Plus, I really enjoyed the theme carrying through of the tomato business, so that was phenomenal. Just your accounting was a little off, so no big deal. You're not graded on the accounting. The content was good overall, though. Nice job. All right. Well, let's get back into the material. We're going to talk about treasury stock. This is a way that a company can own its own stock, but with the intent of reselling it. So it's not typical that an organization would necessarily own its own stock and then vote with it. It's really the intent of treasury stock to really just kind of buy it and then sit on it so that they can then resell it. So let me share my screen. And what we're going to do, probably in about, I don't know, 20 minutes or so, we'll take a break to work on one of the homework assignments. But instead of breaking up into breakout rooms, I figured since we're a small enough class, we can just kind of work on it together. So hopefully that works for you guys. Okay, so treasury stock. So these are shares that have been already issued by the company, but then they've been reacquired by the corporation. All right, so it's important for the company to record the cost at which they purchased the stock. So this is commonly known as a stock buyback. This has kind of been in the press lately during the early parts of the pandemic, when the government was giving out trillions of dollars of aid. And the government's, trying to pass another trillions of dollars of aid to assist during, this poor economic time. Although, the government just released actually new economic growth figures for this last, I think this is the last month of the last quarter, and showed that the economy is actually rebounding pretty strong. But regardless, there's still several areas that the economy is, incredibly weak on, and people are still out of work. A lot of people are still out of work. About half the jobs that we lost are back, but the other half, some of them are largely are quickly becoming permanent job losses. So anyway, so there was a lot of press around the companies taking the aid that the government was giving and buying back stock. There wasn't, there weren't a ton of companies. It wasn't like this was this, mass problem, but there were targeted organizations that were buying back their stock. And again, the reason why companies would do this is so that the company's stock price would go up, right? So it's just the basic law of supply and demand. If you reduce the supply, the price goes up, right? Because if the demand stays constant and you've got less of that product in the marketplace, then you have no choice but for the price to actually go up. So it's a fairly common technique for organizations to buffet up their stock price to buy back their stock. So treasury stock does not have any voting or dividend rights. So it's not like the company can just buy back the stock and then they have total influence, which is why I pointed out in your example, guys, that if the company still maintains significant portion of their stock, that's fine, but that doesn't give them any additional rights. They don't get dividend rights, they don't get voting rights. They're just holding on to it as a means to hopefully resell once the stock price gets higher, or they'll just hold on to it in order to keep the stock price artificially high. And then when they book the treasury shares, they're going to book them to something called a contra equity account. What that means is, and you may have seen in the reading, there are contra asset accounts, contra liability accounts. These are accounts that sit in the category in which they're described in. So in this case, the equity section of the balance sheet, but their nature is contrary to the nature of all the other accounts. So it actually reduces the balance in that category. So if you have a contra asset account, for example, and accumulated depreciation is a perfect example of a contra asset account, it reduces the net assets of the company. So a contra equity account does the same thing. It reduces the equity balance of the account. So it's going to be a negative to the overall value of equity in the company. All right, so let's kind of look at some examples in a bit. So again, why would a company buy its own treasury stock? Well, they're looking to increase the stock price. This isn't important, the last one, to avoid a hostile takeover. If there's a company that is stalking another company and is going to force a takeover, a merger, again, a company's best interest might be to go ahead and buy up their own stock, so there's less of it out there, and therefore that kind of stalking horse company that is interested in taking over company A is unable to, because there isn't enough stock out there to give them influence over the organization. You can also artificially increase earnings per share, right? So again, if you think of and we actually get into what earnings per share is next week, but earnings per share is a ratio that you calculate using the earnings and net income of the company and dividing it by the number of shares that are outstanding. So if your denominator, the number of shares outstanding, is smaller because you are buying up the shares, outstanding shares, then your earnings per share by consequence will end up being higher. Okay, so that's one way to artificially inflate your earnings per share. You can buy up your shares in preparation for a merger. So if if a company has offered up a tender price for shares, you can kind of get ahead of it and start buying up those shares from the shareholders at that tender price as you kind of prepare for a merger. And then another common way or common reason for buying up shares is for an employee stock option plan. You buy up the shares and then you either resell them or you grant them, don't necessarily resell them, but you grant them to employees at a particular price. And then they can then resell them into the marketplace once the stock price gets higher than the price that they were granted to them for. So all sorts of reasons why a company would buy up its own stock. Okay, has anybody heard of any of these before? Seen this in the business press? Maybe been part of this in a company that they work for?
Yeah, I had a quick question, Brother Crable.
Yeah.
One of our family friends, he's pretty high in his company, so they offer him like a certain amount of shares over a certain period of time at a lower rate, so he can, I guess, buy more, and it makes him want to stay there longer. And it's like that for 5 years. Would that be part of treasury stock, or would that be a different type?
It kind of depends on how it's structured. It certainly well could be. So the company could be buying up its own stock and then kind of granting it to your family member. at a lower price, and then so your family member would be given this stock, and then the ownership of the stock would be vested over 5 years. It sounds like.
Yeah, and they
So
can't pull it out until like 5 years, something like that.
yeah, so every year he gets like, he or she gets like 20% of the grant, and then they can turn around and sell it in the stock market, and at presumably a higher price. So absolutely, that could be, that they could be using treasury stock to fund that. It just kind of depends on how it's structured. Sometimes you get options. You don't necessarily get the actual stock itself, and so options are a completely different mechanism, and those are we don't get into deeply into how stock options work. I mean, it's they there are different types. There are a lot of different types of stock options, very complicated stock option valuation methodologies and how you calculate that. But that's beyond the scope of this class. But they certainly could be using treasury stock as a way to fund that. Any other questions? All right, well then let's look into how the accounting for treasury stock works. So we'll use the Nelson Company has paid $20 per share to buy back 50 shares of the $10 par value stock. Okay, now remember, we're gonna book anything related to common stock using the par value. Okay, so if we've got common stock, the value that we're booking there is going to be the number of shares times the par value. If we have preferred stock, it's going to be the same thing, par value times the number of shares, or stated value, which means the same thing as par value. Okay, and then the amount of cash that is going to be received, or in this case dispersed, is going to be the stock price times the number of shares. That's going to go under cash. And then the difference between the cash amount and the common stock, preferred stock, or treasury stock amount falls under paid in excess. And so in this case, Nelson paid $20 per share for 50 shares. So that's the $1,000 right here. Okay, and then the remaining amount, or actually the same amount goes under treasury stock. So treasury stock does not have paid in capital in excess of par yet. They will do that once we sell the shares. But when the company is acquiring the shares, it just books the full amount that they bought them for under treasury stock. All right. So right now, it's a reduction of cash of $1,000, and it's an increase of treasury stock of 1,000. And this is going to be a contra equity account. So this is actually going to reduce the balance of equity. Okay, we'll kind of see that in just a second. And then the purchase of treasury stock is a financing activity on the cash flow statement, and that's going to be an outflow of cash, which is why it's negative. So now the company decides to resell that stock at $22 per share. Okay, and we actually don't show the bookkeeping of that, so we'll actually skip to when they resell the shares of its treasury stock at $25. So they're going to take 30 of the 50. So they bought 50 shares. They're actually now only reselling 30 of it at a much higher price. So the 30 shares times the original price of $20, okay, the $20 cost, that's $600. They're going to reduce the treasury stock price by that amount. Okay, they're going to receive cash of $750. Okay, and the difference gets booked to paid in capital from treasury stock. Okay, so by reducing treasury stock, you're actually increasing the equity. So let's kind of look at our accounting equation so we kind of walk through that a little bit better. I think sometimes it's a little complicated to see. Okay, so let's go over here And we're going to create a couple new accounts. All right. All right, we're going to erase these transactions that we had. Oops. Okay, so let's say the company has issued, we're going to say 100 shares at $10 par, right? And they sold them originally for $30 a share. Okay, so first we're going to book the common stock, so 100 shares times 10. There's $1,000. And then we're going to create another account for paid-in capital in excess of par for the common stock. Okay, and then the company has received in cash $30 times the 100 shares, so $3,000. And now, the paid-in capital common stock is going to be the difference between the $3,000 and the common stock. All right, so is everybody with me so far? All right. So now the company's going to buy back, for treasury shares, they're going to buy back 50. Okay, still the same par value. Again, at this point, that doesn't matter too much, and they're buying them back at 20 bucks. All right, so under treasury stock, so they're going to take that $20 times 50. So they're going to reduce their cash by 1,000, and treasury stock is going to be booked exactly the same way. It's $20 times 50, but it's a negative. Okay, so that's what I mean by contra equity, right? So right now we've got we've got $3,000 in common stock value, but since they bought back 50 shares, that 50 shares that they bought back reduces that equity balance. That's why they call it a contra equity, because it reduces the overall balance. So now we're in balance, right? We've got $2,000 in cash and $2,000 in equity. So now they're going to resell that stock. Let me see if I can fit. Okay, so now they're going to resell that stock at $25, but they're only going to resell 30 shares. So they bought back 50, but now they're only selling 30 at $25 per share. So they're going to receive 25 times 30. So they're receiving $750. Okay, they have to remember that the original cost of the treasury stock was 20 bucks. So now they're going to reverse for $20 at $20 per share, 30 of that. So that's the reduction of treasury stock by $600. Okay, and then the difference between what they sold, what they bought it for, which is 20, and what they're going to receive, what they received, which was $750 at $25 a share, goes under paid-in capital. So that $5 times 30 gets booked to paid-in capital in excess of treasury stock. Okay, so that's how that transaction balance is. You're reducing treasury stock and you're increasing that paid-in capital in excess of par, or in excess of not par, but cost. Okay, does that make sense? Everybody confused how I got there? No. Speak now, forever hold your peace. Okay. And we'll keep going then. All right, so now we'll move on from treasury stock and we'll talk about the different types of dividends that companies can issue. First, we'll talk about cash dividends. So cash dividends, that's just another way that, or that is the only way, I should say, that a corporation pays out profits to the stockholders. It's called a dividend. Okay, it's a cash payment that the stockholders receive. A lot of times you'll hear in the business press that they're paying out dividends in terms of dollars and cents per share, right? So, you know, Apple is paying out a, you know, $2.50 a share dividend. So if you own, you know, 10 shares, then you're going to get $25 from Apple. You're going to get a check of $25 for Apple from Apple. And it's a way that, you know, if a company is doing really well, they've got a lot of cash, and, you know, it really makes their stock attractive, because not only will a stockholder receive, you know, appreciation of that stock, right? The stock price will go up, but they'll also receive these, you know, periodic cash payments. And a lot of people, when they value a stock, they're looking at both. They're both looking at how much cash, you know, that stock is going to generate for them by virtue of dividends, and what's the history of the stock. Is the stock price going to kind of go up over time? Is the business such that there's going to be a high demand for the stock and the stock price is going to go up? So it's actually, you know, a positive thing for corporations to pay out dividends. It's a positive impact on stockholders. But they have no legal requirement to pay out dividends. So companies never have to pay out dividends. But once they declare a dividend, once a board of directors says, yes, we're going to pay out a dividend, they are then legally obligated to pay it. So they can't rescind a dividend payment once they've declared it, but they don't ever have to pay out dividends at all. So some important information that's critical to the accounting of dividend is when it's declared, when the board of directors approves the dividend, they have to then record the liability for that dividend. They don't pay it yet, but they then have to book the liability. So they're going to increase. If we were to look at our accounting worksheet, and let's just change our unearned revenue to dividends. Okay, and let's just pretend that we've got, I don't know, $50,000 in retained earnings. Okay, and if a company declares a dividend of $10,000, they're going to increase dividends payable, and they're going to reduce retained earnings by that same amount. So that's the point at which retained earnings gets impacted, is on the declaration date. All right, then at the future date when they actually pay for it, then on payment date, they'll reduce cash, and then they will zero out the payment, the dividend payable. Okay, so this is on declaration date, and let's make a little note. Make a little note down here. And then this is on payment date. Okay, so now the date of record is the date in which you have to own the stock in order to receive the dividend. So that date doesn't have any impact from an accounting perspective. You're not going to record anything specifically related to the date of record. You are, the two dates that you care about are the declaration date and the payment date from an accounting perspective. But the date of record, that's just, so in theory, you could actually not own the stock the day before the date of record, buy the stock on the date of record, and then sell the stock the next day, and you'd be able to receive the dividends. So the company does not care how long you own the stock, just as long as you own the stock on the date of record. Okay, and that's mainly because, you know, there's no way the company has to pick a date of when, you know, when people own the stock in order to pay out the dividends, because stocks and companies exchange hands literally every day. Well, literally like every minute of every day when the stock market is open. And so they can't, you know, with this ever changing target, right? They have to kind of pick, you know, draw a line in the sand and say, okay, at this date and this time, as long as you own the stock at the end of this day, then we will pay you a dividend. Okay, after that, you know, we don't really care. So, and that's, you know, that's actually a trading strategy that a lot of people use when they're trying to make money in the stock market. So let's look at an example. So the Nelson's board of directors declared a cash dividend on the 100 outstanding shares of 7%, $10 par stock. So they're going to pay out 70 cents per share at the of the preferred stock. So that's $70. It'll be paid on December 15th to those stockholders on record as of November 15th. So here's the accounting, right? They're going to record the dividend payable and reduce retained earnings. Okay, there's no cash flow yet, right? No cash flow impact because they haven't paid it out yet. This is just the declaration date. Then we fast forward to the next day of, or not the next day, but the next date, a month later of the record date, and the record date, there's no accounting impact at all. So from an accounting perspective, we don't really care about that date, other than that's the date we're basically going to get the records of who owns the stock so we can pay out the dividend. And then a month later, on December 15th is when we actually pay it, and we reduce cash and reduce dividend payable. Okay, and because it impacts cash, then it reduces the cash. It's an entry on the cash flow statement. So as a financing activity. Okay. And we'd follow the same pattern if we were talking about common stock dividends. So they declared a common stock dividend of, like in my example, the $10,000. It follows exactly the same method, where you're reducing retained earnings when you create the payable, and then upon payment, you zero out the payable and reduce cash. All right. Okay, so now how do other types of dividends impact the equity balance? So we've got stock dividends. Okay, stock dividends is basically when instead of cash, the stockholders receive additional shares. Okay, so in this case, there's no change in the total stockholders' equity. Okay, because all they're doing is increasing the number of shares that each stockholder owns, and they do it proportional to their existing ownership. So if you currently own 20% of a company, and they do a stock, and the company declares a stock dividend, you're going to get 20% of those new shares that they're issuing, so that your total ownership never changes. And there's no change in the par value in a stock dividend. All they're doing is increasing the number of shares. So let's look at an example. So the board of directors decided to issue a 10% stock dividend, meaning that everybody gets 10% more shares. And so they have 150 outstanding shares, which means they're going to increase it by 15 shares. And the par value is $20. The market value at the time is $30 per share. All right, so they're going to take 15 shares, multiply that times their par value, okay, of $20. That's $300. That increases the common stock account. All right. They then take the $30 of the market price times the 15, which is 450, that's going to reduce retained earnings. Because remember, anytime we pay out a dividend, it's going to be paid out of retained earnings. It reduces retained earnings. Okay, retained earnings is that bucket of value that is, basically the right of the shareholders. And so anytime any payment, any sort of dividend goes out to shareholders, it comes out of retained earnings. So they're going to reduce retained earnings by the full value, the market price times the number of shares. And the difference between the par value and the market price then gets booked to paid in capital in excess of par. So you can see that the total equity amount stays the same, right? It's just you're putting it in different buckets. You're increasing common stock, you're increasing paid in capital, and you're reducing retained earnings for that same amount. Okay, so let's kind of look at the mechanics. Let's just post it to our equity here. So we've got $40,000 of retained earnings. We're going to issue, we had 100 shares at $10 par. We're going to issue at 10%, so that's 10 more shares at that $10. So that's going to increase, so 10 shares. And let's just go and put in the full equation. So we had 100 shares, oops, and we're going to do a 10% stock dividend, okay, at a $10 par value. So that's $100. Okay, we then are going to reduce retained earnings by the number of shares that we're giving out as dividends. Okay, that's 10 shares at the current market price, and we're going to say it's at $30. Okay, so that's 3, and actually that should be a negative, sorry. So we're going to reduce retained earnings by that amount. Okay, so the difference, you've got $100 of increase, $300 of decrease. That means we need to balance this out so that it's equal to 0, which means the difference between the market price and the par value. Okay, so if our market price is 30, our par value is 10, that means we've got a difference of $20. So 100 shares times 10% times that $20 difference gets booked to paid in capital in excess of par, and then our entry balance is to 0. And then magically, everybody has 10% more shares this way. I'll stop there. Does anybody have any questions? That seem confusing to anybody? No? Okay. All right, stock splits. Okay, so this is where you're basically, it's similar to a stock dividend where everybody gets a higher number of shares. It's just going to be dealt with in a little bit different way. So instead of owning, again, I've got 10 shares, we're going to do a stock split. So for every share you currently own, you get, say, 3 shares. So instead of owning 10 shares, I'm now going to own 30 shares. All right, and again, this is a common way to reduce the market price. Okay, Apple just went through a stock split this summer, which drastically reduced their stock price. I think it was trading at like nearly $500 a share, and then once they split their stock, I think it was a 3-for-1. So everybody that owned 1 share, you got 3 in its place, and so that basically reduced their stock price down to a third. Okay. The total value basically stays the same. This is a way to increase the number of shares out there and to make it, more accessible for people to own shares of the stock. Retained earnings in this case, though, is not affected. That's one of the differences between a stock split and a stock dividend. All you're doing is reducing the par value. Okay, it's a very, very simple accounting process. All you have to do is reduce the par value by the amount that that you're providing a stock split for. So in this case, in this example, the Nelson company declared a 2-for-1 stock split. Okay, so their par value right now is at $20. There's 165 shares outstanding. Okay, all they have to do is take their eraser, erase the par value, divide it by 2. So now instead of 165 shares, there's 330. And the total value does not change at all, right? You don't have to book an entry. All you're literally doing is just changing the par value. So there's nothing to record. If we go to our accounting worksheet, there's literally nothing to record here. Okay, if we had a record of the par value, we would just change the par value and divide that by 2. So there's no entry here. It's not going to show up on a cash flow statement because there's no cash being exchanged. All right, so we got the appropriation of, we're going to skip that because that is not something that we need to worry about. Okay, so we'll talk a little bit about how stock information is used to help kind of analyze whether or not, a stock is a good investment. As I said before, a stockholder would look at whether or not, the company is paying dividends. That stream of cash through dividends, even though it may not be, huge, depending on the number of shares that you have, it's still cash. It's still cash you didn't have before. So that's a return that you're going to receive. So people look at stocks by the dividends that are paid out and the history of the stock price, okay, and the performance of the company. So some companies never pay out dividends, right? They're low, or they pay very low dividends. But their stock price might be made up by, a better than average increase in the stock price. And everybody's kind of comparing the performance of a stock to the stock market as a whole. So, and there are different indices to be able to look at that. You can look at the S&P 500, you can look at the Dow Jones Industrial Average. There are a lot of different indexes that you can kind of use to determine what you would, consider the market as a whole. And so if your stock kind of beats that average increase, then it's generally a good investment. Okay, if you combine that with the fact that that company pays out a dividend, then you're in a really good shape, and that's a stock you might want to hold on to for a long time. Now, you might have heard of 2 different terms of companies: a widely held company versus a closely held company. A widely held company just means you've got a lot of stockholders. There are a lot of people throughout the world that own that stock. Versus a closely held company means you've got, a very tight circle of people that own the stock of that company. Okay, closely held companies are typically private companies. You might have, many shareholders of a private company, but it's not a widely held because they're not publicly held. Or what some companies will do, like Comcast, Ford Motor Company, those are 2 good examples. Google, is they'll have a class of stock that is widely held, but the stock that actually controls the organization, that has all the voting rights, is closely held. And that's closely held by, for example, the Ford Motor Company is closely held by the Ford family. The generations of, that came after Henry Ford, they still own the vast majority of the voting stock. So the Ford Motor Company can't really do anything without the Ford family's approval. Same thing with Comcast. Okay, Comcast is owned by, I'm blanking on the CEO's last name right now. But his family kind of, took over Comcast as a cable company, built it into the media behemoth that it is, and they own basically all the voting stock. Same thing with Google. Okay, the two founders of Google, Larry Page and what's the other guy's name? Anybody know? Like Serge, I can't think of the guy's name. Anyway, and then the first CEO of Google, Eric Schmidt, the three of them own the vast majority of the voting stock. So they're the ones who control the way the company is managed. Okay. So that's it on equity. Anybody have any questions before we get into the homework? No? Anybody have stock advice? Anybody have a stock that they've owned and are doing quite well on?
I have
Stock market's gone down the last couple of years.
I have
Yeah, go ahead,
stock,
Jeremy.
I have stock in the QQQ, and I'm not sure how I haven't checked on it since, but it's just like this general thing that I put my stock in. And my stock is like being monitored by, I think, Morgan Stanley. So like they asked me like when they first met with me like what I'm into, and I said electronic, like technology and business. So they put it in the QQQ. And
Okay, so it's probably that's probably a mutual fund, right? Where they probably have bought a basket of diverse like tech companies.
yeah, and so I think it's doing pretty well. I haven't checked today about it, so.
Okay.
I also have a stock in Apple, and I was one of the beneficiaries of that. I think it was a 4-for-1 split.
4-for-1. Okay, thanks. Couldn't remember if it was 3-for-1 or 4-for-1. Good. Yeah. So I don't know if you bought it pre-pandemic. We bought some shares of Apple actually after I think it was their July, right before the stock split, because seeing how well they did when the pandemic first started and how resilient their business model was, I was like, wow, this company's going to be around. Like, there's nothing that's really going to take down this company. So that's why I felt like it was a good investment. Now the government might have, different plans. They might take down Apple in different areas, but I think as long as they can continue to innovate and create products that we didn't know we wanted, and services we didn't know we wanted, then the future's pretty bright. Okay, so let's look at and I've been talking for the last 40 minutes, so I'm going to talk less as we kind of go through this. I'm going to ask you guys for your direction on how to complete these problems. So let's just start with problem number 1. Go ahead and bring up your McGraw-Hill assignments so you can kind of enter in the answers as we kind of go through it. And that way you can get a head start and you don't have to you don't have to spend today and tomorrow just doing all of your homework. So let's see how much we can get through in the next 20 minutes. So the Higdon Corporation was organized on January 2014. It immediately issued 5,900 shares at $50 par, 7% cumulative preferred stock, and 11,500 shares of $10 par common stock. Okay, we've got some information as to what their earnings were for a couple of years. In 2014, they had a loss. In 2015, they earned money. 2016, they earned money. And they did not pay a dividend in 2014. All right. So they started in 2014. They didn't pay any dividends because they were at a loss. Right. They lost money. So how much, since they're Well, first of all, do we know whether or not the preferred stock shareholders are supposed to be paid dividends in arrears? And how do we know whether or not they're owed dividends in arrears? What's the key term?
Cumulative, right?
Cumulative. Thank you, Megan. The silence was deafening. Okay. Yes, cumulative. That's the key word. So if you see the word cumulative, that means that the preferred stockholders are owed dividends every year. If the company does not declare a dividend, it does not pay that out, then the preferred stockholders are owed that dividend in the following year or whenever the company decides to pay dividends again. Okay, and they're owed for all the years that the dividends were missed. Okay, so that's the key word, is cumulative. Thank you, Megan. So how much of how much dividends does the company owe to the preferred stockholders at the beginning of 2015? Who wants to take a stab? First of all, which class of stock are we talking about here? Are we talking about the preferred stock, or are we talking about the common stock?
It would just be the preferred, correct?
Yep, that's right, Megan. We're talking about the preferred stock. Okay, so let's just focus on the information we have about the preferred stock. So let's break this down. So we know that they issued 5,900 shares of preferred stock at $50 par, and the dividend rate is what?
Seven percent.
7%. Thank you, Sarah. Exactly. So 7%. We know that the dividend rate they have to pay is 7% of that par value. Okay, so let's break out a calculator. All right, so that's 7%. As the decimal is 0.07, right? Okay. And then we multiply that times what? What are we basing the 7% off of?
50.
Yep, very good, Jeremy. 50. Okay, so for each share, they're going to pay $3.50 in dividends. How many shares did they issue? How many shares of preferred stock are out there?
5,900.
5,900. Very good. So this is the amount of dividends they have to pay every year to these preferred stockholders, 20,650. Okay, if they don't pay it, then they have to pay it the next year. It just accumulates. Okay, that's why that cumulative word is so important.
Hey, Brother Kriegel.
Because that, yeah.
Your numbers are different from the ones I'm looking at.
Yeah, everybody's problem will be a little bit different. So the concept's the same, but you might have, different par values and then different number of shares, different percentage. Okay.
I thought I was going crazy. Like, I do not know where you're getting this 7% from.
Okay. Yeah, sorry. That's just the way that McGraw-Hill tries to keep everybody from cheating off of one another, is to kind of make the numbers different. But we're trying to do this together as a class, so it does make it a little more complicated. But yeah, just so your numbers might be different, but the concept's the same, right? When you're calculating the dividend amount, you're going to take the number of shares times the par value times the dividend rate. Okay, and that will go into the dividend arrearage box, because that's the amount that they owe from 2014. So at the beginning of the year, they owe that to the preferred shareholders. All right. So if your numbers are anywhere close to these, you can put that in the box. All right. So part B, now the board of directors declares a 53,300 cash dividend. Again, your numbers will be different at the end of 2015. Okay, we have to remember that they owe dividends to the preferred stockholders for both 2014 and 2015. So this 53, the total amount of cash dividend, we're going to put in the first box. Okay, now we got to split it up between preferred shareholders and common shareholders. Okay, so we already know how much we have to pay to the preferred shareholders for the 2014 arrearage because we calculated in part A.
Wait, where did you get the total dividend declared?
It's given to you right here in the problem.
Got it.
Okay. So we know the amount in 2014 and we know the amount in 2015 because the simplicity of this preferred stock dividend, it's the same amount every year. So if we know it for 1 year, we know it for the next year. So we're going to pay another $26.50 in 2015. All right. So that leaves us, so we're paying a total of $41,300. And if we break out our little calculator, we started with 53,300. And we're subtracting the amount that we paid out to the preferred shareholders. Oops. So that leaves us with $12,000 that we can pay out to the common stockholders. And that's exactly how much we give them.
So you minus the 53,300 by the 20,650.
Yeah, twice. Right? Because you're paying it to them. You're paying them 2 payments of $26.50 because you owe them for 2014, the year that you didn't have any dividends. Okay, and then you have to pay them again in 2015. That's the beauty of that cumulative feature to the preferred stock is you're guaranteed to be paid that amount every year. And if in a year the company decides not to pay a dividend, then you're still owed that money as a preferred shareholder. You'll just get it when the company declares a dividend, the next time the company declares a dividend. And in which case they declared it in 2015. So they will receive 2 payments of $26.50. And then anything that's left over, that's what goes to the common shareholders. So the common shareholders, they just get the crumbs of what's left. Does everybody understand how I broke it up? How we got there? Yep.
How'd you do the last two again? The available for common shares.
So you take the total dividend declared and you subtract the 2 payments to the preferred shareholders.
Okay, that's what I thought.
Okay. We ready to move on to the next problem? You guys good? Everybody comfortable? Okay. All right. So the J&J Corporation had the following stock issued and outstanding at the beginning of 2014. They had 200,000 shares of $10 par common stock. Again, your numbers might be different. right? But how we approach it is going to be exactly the same. And then they've got preferred stock, 8,000 shares, $100 par value, 4% dividend rate, but this is non-cumulative. Okay, so again, what's the difference between cumulative and non-cumulative?
One would build upon itself, one doesn't.
Yep, very good. The dividend builds upon itself under cumulative. Under non-cumulative, there are no dividends in arrears. So if the company does not declare a dividend that year, the preferred stockholders are not, they don't get paid in a future year. They don't get a dividend, just like common stockholders don't get a dividend. They're not owed anything. So that May, the company declares a cash dividend on the preferred stock, okay, and a 50-cent per share dividend to add to the common stockholders. They'll be paid on June 15th for the shareholders that are on record of May 30th. Okay, so let's calculate the total amount of dividends that will be paid. All right, so let's start with the preferred stock. That's the little more complicated one. So the 8,000 shares get paid how much in dividends? What's the dividend per share? What's the dividend? How do we calculate that? So what's the dividend rate for the preferred stock? I know you guys are each going to be different, but let's look at the problem that's on the screen right now.
4%.
4%. Very good. So 0.04. That's our decimal, right? Okay. And then what do we calculate that dividend rate off of?
You do $100?
Yep. $100 par value. So we're going to pay $4 per share. And how many shares of preferred stock are we paying on?
8,000.
8,000, yes. Okay, so we're starting with $32,000 of dividends paid to the preferred stockholders. Okay. So we'll set that aside. Just remember, let's write that down, 32,000. Okay, now we're going to add to that the dividends that we're paying to the common stockholders. And the company declared a 50-cent per share dividend. So we'll start with 50 cents. Okay, what's the number of shares that we're going to multiply that by?
Is it the $4 per share?
No, because we've already, that was related to the preferred stock. We're now focused on the common stock. The $4 per share was the dividend rate for the preferred stockholders.
Oh, so would it be
this is the dividend rate for the common stock?
Would it be then you'd take the 2,000 shares times the $10 per? Is that what you do?
Would it
So,
be the 50 cents?
It's 50. We start
I'm
with 50
confused.
cents. That's the dividend rate. So you're right, Cami. We're talking about the common stock line. Okay. So we already know we only have to worry about the par value when we're calculating dividends when it comes to preferred stock, because the way that dividend rate is communicated is it's a certain percentage of the par value. For common stock, it's different. They'll just declare a value per share. In this case, they're giving us 50 cents per share. So we don't have to worry about the par value when we're calculating common stock. Okay, we can ignore that piece of information. At this point, we only need to worry about the number of shares that we're paying that dividend out to. Okay, so it's the 200,000. So you had said 2,000, you just missed a few zeros. 200,000. So 200,000 times the 50 cents is 100,000. And then we add back the $32,000 that we calculated that's going to be paid out to the first stockholders, because we need to calculate, right? We're being asked what the total amount of dividends are. So it's $132,000. Okay, did I lose anybody on how they were calculated? Okay, so for common stock, you take the dividend amount per share, multiply that times the number of shares. So that's $100,000. Then for preferred stock, so just to review, you take the dividend rate of 4%, multiply that times the par value. That gets you $4. Multiply that times the number of shares. That's 32,000. You add the two together, the dividend paid amount is 132,000. Okay, again, your numbers are going to be a little bit different, but the mechanics are exactly the same. Okay, we good? Questions? Anybody lost? No? Okay. All right. Let's see if we can get to questions.
Sorry, my internet was out for like half of the class, so I'm just a little behind here, but I'll just have to watch the video.
Yeah. Once we finish, I'll post the link. You can watch. It's a bummer. Everybody's internet is off and on out. Makes it very frustrating when you're taking a remote class. Okay, so let's have a little more practice on calculating preferred stock dividends. This will be the last thing we'll do, is part A. So the Tidwell Company issued a 4% stock dividend on 20,000 shares of its $10 par value common stock. And at the time of the dividend, the market value of the stock was $30 per share. Okay, so what they're going to do is they're going to increase the number of shares by 4%. So let's start with our 4% decimal, 0.04, and let's multiply that times the number of shares that are outstanding. How many is that? Based on the problem on the screen.
20,000.
20,000. Very good. Thank you, Mary. So they're going to increase it by 800 shares. Okay. Now, which number do we calculate when we're talking about the value of the dividend? Is it the par value or is it the market value?
Is it the market value?
It's the market value. Very good, Mary. Yep, it's the market value. So you're going to multiply the 800 shares by the $30, and that's $24,000. So the stock dividend value that they're giving to the stockholders is $24,000. Okay, and that goes under stock dividend. So this next, we'll do this real quick. If you guys have to leave, it's 8:30. Feel free to go. For those of you that can stay, we're going to finish through this, and then it'll be on the recording, so you guys can watch it at the you can watch the tail end. So now let's just show the effects of the stock dividend on the financial statements. Okay, and all we're going to put in is whether or not there was an operating activity, investment activity, financing activity, or no activity at all. Okay, so so for assets, okay, did we pay out any cash when we paid this dividend? Did the asset change at all? When we pay out a stock dividend, let's go back to the problem, or let's go back to the presentation. Let's go to stock dividends. Okay, let's look at the accounting, right? So when we book the stock dividend, all of our activities in the equity section. Okay, so we're not going to actually, there's not going to be any impact to assets or liabilities at all. Okay, so that's going to be zero. Zero in assets, zero in liabilities. Okay, Nothing related to revenue, nothing related to expenses, nothing related to net income, okay? So we're gonna ignore all of those. Since we have no impact on cash, there's no impact on the statement of cash flow. So that's gonna be an NA, okay? So we can just get that stuff out of the way. Let's just get rid of that because that's just noise right now, okay? So let's just focus on the accounting. So if we go back to the presentation, okay, we know that we have to book the market value of the dividend as a reduction to retained earnings. So the 24,000 that we calculated is going to reduce retained earnings. Okay, now we got to break it up between the par value and the paid in excess of par. So remember, we had 800 shares that we're paying out as a dividend, and the par value is $10. So 8,000 of that 24,000 is going to go under common stock. And the balance, the difference between the 24,000 and the 8,000, then gets booked to paid in excess. That's how the stock dividend is booked. Okay, there's no impact on cash. There's no impact on liabilities. Okay. Any questions? All right, so we went through 3 out of the 5. There are 2 more problems. The video that I posted earlier this week that goes over the homework problems, that will also, that I believe that goes over the last 2 problems, if I'm not mistaken. But the last 2 problems are pretty similar to the first 3. So you guys can at the very least review what we've done here to help you kind of get through the last 2. Okay. And as always, you can send me a text or give me a call, shoot me an email if you have any other questions. All right.
Thank you.
Thank you
All
both.
right. Absolutely. Have a great weekend, guys. See you on
Thanks.
Tuesday.